decision making around provisions for credit. What's the thinking at the bank? And I guess more importantly, what do you see as sort of the evolving trend in that department?
Sure. Well, it's been an unprecedented year, clearly, as Q1 started off very well and we had to adjust and deal with COVID in the second and third quarter. And clearly, we're proud to end the year on a very strong note. But it shows the resilience of our business that we're able to increase our allowances for credit by some $2.7 billion and be profitable throughout that period. Our capital levels went up, and our gross impaired loans went down. So we're very pleased with our performance during the course of the year. We feel good about entering 2021. And I think it speaks to the resiliency of the Canadian consumer, Canadian businesses, and what we're seeing throughout our Latin American franchises, where business is coming back very, very quickly.
So when we entered, we haven't spoken since the great lockdown that began back in March as the pandemic, shut everything down. The banks were very prudent, and one of the kind of questions at the time was, how conservative were the banks being in terms of what could go wrong? It seems quite conservative, as is the Canadian culture, perhaps. We're in kind of a second wave here, a second lockdown. It's not the same. How do you measure how bad it will be? Because on the one hand, we've got lots of government support already in place, and on the other hand, Brian, you have businesses and consumers that were already stretched.
Yeah, well, I'd say, I'll make a note of government support. I think the Canadian banks and policymakers in Ottawa, the Bank of Canada, got together in March and acted very quickly and in a coordinated fashion to help Canadian households, consumers, and small business. And I think that's had a big impact in terms of where we are right now. And whether it's CEBA, whether it's CERB, whether it's rental assistance, wage subsidies, these programs are having the intended impact. And I applaud the government for these initiatives. But, whether we go into we're obviously in a second wave here in Canada. I think from a medical perspective, we know how to handle the cases better. Hospitalization rates, at least in Metro Toronto, where we live, as they're stable, they're not increasing. They are in other areas of the country, which we're aware of. But I think that we can adapt to that. There's lots of stimulus in the economy that's having the intended impact. So I think we'll get through this. All crises come to an end. In terms of Latin America, which some countries had if I could describe it, as a pretty good COVID. Chile, for instance, was procuring PP&E and increasing hospital capacity in January, actually. And they had a pretty good COVID. Peru had a more difficult time because of a lack of hospital capacity. So the COVID experience has been varied in terms of the geographies where we operate. Mm-hmm. But in Canada, I think it shows the resilience of the consumer. The small business corporations' balance sheets were strong going into the downturn. So, we're seeing companies redeploy capital, look at acquisitions, and, there has been some structural impact to the discretionary part of the economy. But I think that from our bank experience, we've certainly accounted for that in our allowances, and we feel good about, cautiously optimistic about 2021.
So let's just stick with those, the Latin American markets. It's one of the things that sets your bank apart from the other Canadian banks in terms of your exposure and growth there. One question that's been raised about the bank's Tier 1 capital levels, because you're hampered at the moment to do buybacks or dividend increases, it might put pressure on for acquisitions, or at least make the prospect of acquisitions more palatable right now. Is that something on your mind, and is that a region you'd look to do it?
Well, it's, when you go through a crisis like this, opportunities do arise. But from a capital allocation perspective, we're focused on two things. One is investing in our own businesses here in Canada, whether it's our Canadian domestic retail and commercial banking business, our global banking and markets business, our wealth business, and in our international business. There's lots of room for us to grow organically. So that would be point one. Point two, we think our shares are still inexpensive and very attractive. And when the regulator gives us the green light, we'll be buying our own shares back. So those would be the two avenues of capital deployment for 2021. it would be speculative for me to talk about a potential acquisition because, quite candidly, we don't have anything in mind. As you know, we were quite acquisitive in the wealth management space. We bought Jurasowski Fraser and MD Financial. Those have worked out exceedingly well. Our domestic wealth numbers were up 14% last year, and in 19, and last year they were up 14%. So we're very proud of those acquisitions. We integrated them well, and a great strategic fit for us.
Looking at your dividend yield, 5.4% at the moment is a pretty generous yield, and certainly would make the bank attractive. But as you say, you are well below your 5-year high on the share price. A, do you have a yield target? Do you have a place where you like your dividend yield to sit? And what is it? And B, what gets you back to that 5-year high?
Yeah, I think we have lots of conversations about this internally and at our board. I think that the marketplace got way too concerned about Latin America, and I think that's probably easy to do in a period like this. But as I said, Chile had a good COVID. Mexico, not so bad, despite some of the headlines. Colombia was fine. Peru had a more difficult time, but these countries bounce back. We've got lots of experience in these environments. We know how to operate. We have a great risk appetite. The Peruvian economy grew 30% last quarter. They issued a 100-year bond that was well oversubscribed. So, and you look at the performance of the Mexican peso in the last 6 weeks, it's ripping. So, these countries are coming back. When they come back quickly. And I think that's what the market's underestimated. And, we had a good quarter in terms of recovery in our international business, and we would expect that sequentially through 2021. So that's why I say we find our stock very attractive, and when we get the opportunity, we'll be buying more shares.
We've seen, Brian, across the business world, and the thing that jumps out are real brick and mortar stalwarts like McDonald's closing down their brick and mortar operations through this pandemic, are taking this opportunity to close some stores. Do you think the banks will be part of that trend? The trend towards digitization was already happening. I know there's a real belief in having kind of the corner branch still out there, but will we see a reduced footprint?
Yeah, good question. And I'll answer it from Canada's perspective and an international perspective. So in Canada, we're opening branches. We opened a new one in a flagship branch in downtown Vancouver just a couple of weeks ago. We continue to open branches in the Montreal-Quebec City corridor and the major metropolitan areas in Canada. We've closed a few in rural areas where there was a bit of duplication or overlap, but the branch is still important. And coming out of a period of time like this, the one thing that we know, and our customers are telling us, they need advice. They want to talk to somebody. Digital adoption is certainly up. 50% of our customers, 23 million of them globally, are digitally active, and digital sales are up. So it depends what market you're in. Internationally, digital adoption's been higher than Canada, frankly. And that was partially out of necessity because in some countries the lockdowns were a little more severe than here. So the branches, depending where you are at a different stage, we've closed some branches in Mexico and Colombia during the course of the last 6 months. We'll see a little bit of that in the forthcoming year. But the important point here is our customers are becoming more digitally savvy. We have branches set up in some of our countries in different geographies in terms of training our customers, if you will, or educating them on the digital experience, and that's going very well.